Hi there. I sincerely hope that you're having a fantastic day. We know home buying could be very stressful, painful, and it could drain your energy. If you've been there or you even thought of buying a home, let's go straight to the point. It could be a painful process. There are requirements related to your income, assets, credit, and the type of home that you're looking for. What if I were to tell you that there is a mortgage loan product that will enable you to get in your home with very minimum requirements? If you have zero credit score, that's fine. No worries, we're okay with it. If you were to have a 1099 income and then you switch to a W2 income and then you're back into a 1099 income, the bank wouldn't care. It's okay, that's fine. Now, if you have 3% down payment, that's okay. Now, does it sound too good to be true? Well, there's a catch to it. It's a lease to own mortgage. Hi guys, this is Joel Ventura and I've been in real estate for over a decade now, and I've been exposed to all these mortgage loan products. And today we're going to talk about the pros and the cons, what's good and what's bad about them, and I'll give you my 2 cents as to what you should do when you're come across to this type of loan products. Let's dive in. So pro number 1, very flexible guidelines. Regardless of your credit history, regardless of your income history, you're okay. They will make it work for you. Also, very minimum down payment requirements, as little as 3%. And there is another pro. If you're not a US citizen, well, this could be a pro essentially. It's okay. You could be a tax ID holder and that's fine. So in terms of the pros, that's it. Those are the only ones that I could think of related to this loan product. Let's talk about the cons. All right, team. Let's talk about the negative characteristics of this flexible loan, right? It's so flexible in terms of requirements and guidelines. There shouldn't be that many negatives, right? Well, I'll let you be the judge of it. Let me just grab the list of items. Strike number 1, you will get an equitable title. What's an equitable title, you might ask? Well, it's a type of title that would allow you to enjoy the property, but your name, it's not going to be on title. Whose name is going to be? The bank. So that's strike number 1. Your name, it's not going to be on title. You don't get direct title. So that's strike number 1. Strike number 2, the long term, it's going to be not for 10 years, not for 15, not for 30. It's going to be a 40-year-old loan. Now, for me, 40 years, it's a long term. There could be a lot of life-changing events during that time. So strike number 2, it's a 40-year-old long term. Strike number 3, in any type of baseball game, after 3 strikes, you're done, right? So you get higher interest rates. Higher than what, you might ask? Higher than FHA or a regular conventional. So you think that that's it? Well, there's more to it. Strike number 4, you get to pay mortgage insurance. On top of all that, you have to cover mortgage insurance on your dime for the bank. What's a mortgage insurance, you might ask? It's a type of insurance that covers the bank interest on the loan. So if that's not enough, you will be hit. If you were to refinance, you have to pay a prepaid penalty if you were to refinance to better terms and conditions of up to 2%. Imagine if your loan it's about $100,000, you would make a 2% prepayment penalty. That's relatively the same as paying a down payment, a regular down payment. So let's say if within 3 years, because the prepayment penalty period, it's within 3 years. So if you have a loan amount of about $300,000, that's $6,000 out of the window that you have to pay out of your pocket for you to get better terms and conditions. Last but not least, this type of loan transactions take anywhere between 6 to 8 months. So it's not a feasible time frame for any type of logical human being to be involved in the transaction for that loan. Granted, there are scenarios that they might close in 45 days, but those are rare. Those are the negative items for this type of loan. Let's dive into my conclusion for this lovely video. Alright, team, we have reached the very end of our video. Should you say yes to all these terms and conditions? Should you say yes to paying higher interest rate, paying mortgage insurance, and on top of all that, your name is not going to be on title? I'll say no. It's not worth it. Stay away from these terms and conditions or this type of loans. Run away as far as Neptune. Now, if you're truly thinking of buying your home and you need to repair your credit, or if you need to save a little bit more, or if you need to find a more stable job, please work on it, because buying buying a home, it's a serious step in your life, and you wouldn't want to fall on these traps of leasing to owning. That those terms and conditions are not meant for you. They're not meant to protect you or your family or the asset that you're acquiring. They're meant to protect the lender or the bank. So that's my conclusion. If you have any further questions, please don't hesitate to leave some in the comment section, and I'll be more than happy to assist you. See you until the next video.